the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this week's episode, we will discuss the important developments with a cover story highlighting IDBI privatization. We have an interview lined up with Baldev Prakash, MD and CEO of Jammu and Kashmir Bank, where he talks about the bank's future strategy. In our Banking for You section, experts explain UPI's single block, multiple debit functionality, and our banking expert Tamal Bandyopadhyay sheds light on the newly constituted National Bank for Financing Infrastructure and Development, NaBFID, and how it would be different from development finance institutions of the past. At the end of the episode, we shall discuss the results of the last week poll and ask you the question for the next one. It has been an eventful week. RBI imposed penalties on 13 cooperative banks ranging from 50,000 to 4 lakh rupees. In other news, the government asked trade bodies and banks to explore more rupee trade deals. But the highlight was the government's decision on IDBI privatization, from reiterating the FDI rule to extending the deadline for bids. In our cover story, we deep dive into the IDBI privatization issue and the implications for a larger privatization drive. Privatization of public sector banks has been a long time coming. While attempts have been made to privatize public sector banks, they have yet to materialize the way the government wanted. IDBI has been a different case though. Many criticized the government when it sold a stake in the bank to LIC. They called it pseudo-privatization or changing hands, as the bank still fell under the purview of government monitoring bodies. However, the government is now making another attempt to privatize the bank, and the deal may finally go through. In October, it invited bidders for a 60.72% stake sale in the lender. Last week, media reports suggested that it will extend the deadline to submit expressions of interest from December 16 to early next month. It also announced that a consortium of foreign funds and investment vehicles can own more than 51% of the lender, and that it would continue primary dealer business even if a foreign bank acquires a majority stake in it. Under the current policy, the aggregate foreign investment in a private bank from all sources is allowed up to a maximum of 74% through the approval route. Concessions and processes are not the only issue faced by IDBI. The other is valuation. The government in October was seeking a 64,000 crore valuation on the bank, which at the time translated into a 25% premium. Given the bank's performance, the premium has come down. But is a premium on this entity justified? Like other private sector banks, IDBI has performed well over the last 2 quarters. In the second quarter of this fiscal, net profit was up 46% annually, and for the private sector as a whole, net profits were up 48%. We talked to Manojit Saha to understand if the government has attached too much premium to the valuation.
IDBI Bank has cleaned up its balance sheet in the last few years. The bank has now a market cap of close to 62,000 crore. The stock has also recouped its losses it made during the COVID years. The return on asset is 1.09%, while the return on equity is 15.21%. Though the gross NPA is 16.5%, but net NPA is only 1.15%. This means that the banks are provided for the bad loans. We can expect positive surprises in the bank's future earnings, as recovery from the bad loans will directly add to the bank's profit and loss account.
The other likely question is if this will open the doors for privatization of other public sector banks. IDBI was an easier sell given that LIC owned a part stake in the bank. Others will require a parliamentary action. But do the foreign route and concessions open the door for easier stake deals? We talked to an expert.
The terms and conditions of the IDBI transactions have been made more attractive by the government, and that could be positive for other PSU banks as well. Apart from this, what we have seen, the PSU banks which had been affected by the corporate NPL cycle had come back strongly in recent quarters, and this has resulted in the decline in the credit cost, which is the NPA provisioning, and also we have seen improvement in the headline and NPL numbers, both gross NPA and net NPA. So what has the overall dynamics itself has become very positive for PSU banks.
Another advantage that accrues to the government is an improvement in finances. Until November, proceeds from disinvestment stood at 24,543 crore rupees against a target of 65,000 crore.
As per the media reports, what we are hearing that the government statement has also come that this can be extended, the bid can be extended till mid-January. And therefore, even for other PSU, we can get the bidding process during this financial year, but transaction would get more likely will get delayed and can go to next financial year. Therefore, we could see a shortfall in terms of the divestment targets.
If IDBI does materialize, the government can again hope for higher targets. Success on the divestment front will bring more changes to the banking sector, which is already transforming with mergers and acquisitions. One of the significant features of private banks' success stories in recent years has been the performance of smaller private banks. Jammu and Kashmir Bank recorded a net profit of 120% of the recently reported second quarter results. Business Standard's Manojit Saha spoke with Baldev Prakash, MD and CEO of Jammu and Kashmir Bank, on the performance and the road ahead.
Hello and welcome to the Business Standard Banking Show. Baldev Prakash is the first MD and CEO of Jammu Kashmir Bank. He was appointed in late December last year after the chairman and managing director's post was split. Before joining J&K Bank, Mr. Prakash was the Chief General Manager in State Bank of India in charge of digital and transaction banking. The bank caught investors' attention after a strong Q2 numbers as it reported 120% growth in its net profit. Also, the gross NPA ratio fell below 8% after a gap of 7 years. Today, we have Mr. Prakash with us to talk about the journey so far in the bank and the road ahead. Mr. Prakash, welcome to the show.
Thank you, Manojit. Thank you so much.
The business of Jammu Kashmir Bank is mainly concentrated in Jammu and Kashmir and in Ladakh region. Advances growth was 9% year on year till September this year. What kind of advance growth do you expect in the financial year?
So, Manojit, as you have rightly said, the concentration of business as far as retail is concerned, that is mainly in J&K and Ladakh. That will continue growing at the pace which is growing. Rather, it will increase because the last 3 months are generally contributing better. So, besides this, now the shift is towards the corporate growth. Corporate growth is expected to come from the rest of India region. That means out of J&K and Ladakh. So there we have focused now for the last around 6 months, the good growth we are seeing in the corporate book. And all these accounts are basically related to high value government PSUs as well as high value rated companies. So that will continue growing, and retail book will support from our home territory, and corporate book will support from the rest of India region. With this strategy, we are hopeful of achieving this credit growth of around 15 to 18% somewhere by the end of this year.
What is the proportion of loans that are from the region and rest of India? What is the bifurcation?
Yes. So from the rest of India, if we see, it's around, as of now, it is around 29 to 30% as of now. We want to take it to above 40% in the long term. So maybe another 2-3 years time, we want to take it above 40%. Then ideally it's 50% in 5 years time.
Right. So that is the medium term roadmap you have, that Jammu and Kashmir and Ladakh will contribute 50% of the loan book and 50% will come from the rest of India.
Yes, yes. We want to actually we want to address this concentration risk in our home territory.
Since you want to since you want to do retail loans in the rest of India also, do you want to increase its presence in the rest of India also?
Yes. So while we will continue to have strategic expansion in the shape of branches, but the first thing will be that we want to do it by way of a tie-up with appointment of more and more DSAs, and then having more tie-ups with like our fintech companies, etc. And that is the priority number one. And in some of the areas, if you find that the branch is required, we will definitely open the branches.
Coming to the asset quality part, as I said, gross NPA came below 8% after a gap of 7 years, but it's still high at 7.67%. How do you plan it to bring it down further?
So Manojit, a lot of effort is going towards addressing this problem of NPA and SMA. And this result is because of that effort. That effort will continue rather with double energy. And right from at the time of SMA, the teams are after those borrowers, and we are trying to reduce the SMA itself below 5%, that probable NPAs below 5%, and want to bring it below the industry levels. And similarly, after this 370 has gone, so now the state is we are able to proceed against the borrowers in SARFAESI action. So those actions we are taking very strongly, and rather all type of recovery actions are now going. And because of that, you see the good things are happening in our NPA portfolio. And this is just a start, I'm telling you. A lot of other accounts, big accounts are there where the resolutions are not far away. And this book will be, NPA and SMA portfolio of this bank will be one of the best. That is what I can assure you.
Do you have a number in mind where you see your gross NPA and net NPA by the end of the current financial year?
Yeah, so for this year, I'm looking around 6% by March 23. But in the say another 3 years down the line, it will be definitely around 3%, 4%, this range. And net NPA will continue to be below 2%, around 2%.
So Tier 1 capital will be in the fourth quarter of the current financial year. Have you
Yes.
thought of the instruments that will be used to raise that capital? Will it be a private placement or a QIP?
Yes. So we have already thought, actually two plans are there. One is that existing shareholders, the government, one of the government, they have shown interest. So we are likely to get from one of the governments. We have two governments which are already the existing promoters. So if you get that, that is good. Well, and if that is not happening, then we will have in the shape of employee stock also, that is almost 50%, and then we have a stake in one of the subsidiaries. We are looking for selling of that stake also. That is plan B.
Which subsidiary is that?
This is PNB MetLife.
And also for your viewers, if you can tell us who are the main shareholders, the government shareholders?
So we have J&K and Ladakh, that is 68%, 68 plus something. And rest of this is LIC is there, and the rest is all retail only. Employees, of course, all employees are also the shareholders.
So J&K and Ladakh, that is the Union government, has agreed to infuse some capital in the bank.
We got assurance, and we are confident that should happen in the last quarter.
You will be completing 1 year in office late December. I think 30th December you will be completing 1 year. You have got a 3-year term. Where do you see the bank after the end of your first term?
Yes. So Manojit, actually this 1 year has been the most challenging one. And now I think the issues which were there immediately impacting the bank almost fixed now. A lot of things have happened in the bank during this year. And basically we have set the fundamental things very right. The bank as of now, fundamentally very strong bank. Business, yes, I'm sure that given the experience we have in mobilizing the business, that is not the biggest challenge for me. Now going forward, the focus will be growing in the quality business. And I'm sure by the end I leave, you will find that J&K Bank will be one of the shining stars in Indian banking scenario.
Mr. Prakash, it was a pleasure talking to you. Thank you for speaking to Business Standard.
Thank you, Manojit. Thank you so much.
Prakash says that besides the retail segment, the bank targets corporate growth, which shall come from outside J&K and Ladakh regions. Most of these accounts are PSUs and high-value companies. The bank is expecting a credit growth of 15 to 18%. Another sector that is booming is digital payments, and RBI provided more fillip to it by allowing single block multiple debit functionality in UPI transactions. But what is this functionality and how will it help e-commerce purchases? Our experts explain.
Last week, the Reserve Bank of India introduced a new functionality to the country's most popular digital payments platform, UPI. The functionality, called Single Block Multiple Debits, allows a user to enable a payment mandate for a merchant by earmarking funds in their bank accounts for debits whenever required. At present, UPI has features which enable the processing of mandates for recurring transactions and single block and single debit functionality. According to RBI, the new functionality will significantly enhance the ease of making payments in the e-commerce space and towards investments in securities. This functionality is expected to have multiple use cases in various segments, such as e-commerce transactions, investments in the secondary market, and purchase of government securities using the RBI's Retail Direct scheme. This new UPI feature is also expected to play a key role in building the framework for blocking money for secondary market trades, a mechanism called application supported by blocked amount, which the capital market regulator is planning to implement. As far as e-commerce transactions are concerned, there are prepaid and postpaid models. The postpaid model is known as cash on delivery. Now, with this feature on UPI, another mode of payment has been introduced. A customer can give a mandate to an e-commerce merchant whereby a certain amount will be blocked for buying goods, and once the goods get delivered, the money will be debited. RBI says this new functionality will build a higher degree of trust in transactions as merchants will be assured of timely payments. At the same time, the funds remain in the customer's account till the actual delivery of goods or services. As per sources, the limits being explored for this new functionality are 5 lakh rupees for secondary market purchases, 2 lakh rupees for e-commerce transactions with verified merchants, and 1 lakh rupees for unverified categories. Whatever limits are decided, this new UPI functionality promises to bring peace of mind to both buyers and sellers.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
With this feature, a customer can give a mandate to an e-commerce merchant whereby a certain amount will be blocked for buying goods. And once the goods get delivered, the money will be debited. The ease of business also comes to infrastructure and development financing sector. India's experiments with development finance institutions have often not taken off, but the government is now making another beeline with the National Bank for Financing of Infrastructure and Development. The bank will soon make its first loan in the renewable space. But will India be successful this time around? We chatted with our consulting editor Tamal Bandyopadhyay to decode how the new body is going to function and whether it can be different from the bodies of the past and how successful it's going to be. Hi Tamal, thanks for coming on the show.
Thank you, Ishan.
Now, in your column this week, you discussed the new entity called National Bank for Financing Infrastructure and Development. The first question that came to my mind was, after the failures of development finance institutions, do we need another such body? Aren't banks and capital markets capable enough to deal with infra financing?
Well, I think the government can answer your question the right best way. Do we need? It's there. You think that 2021 budget announced it, and then the government got into action. It's already got its initial capital, also some grant. Do we need it when the banks are there? No, banks are not a vehicle for infrastructure financing globally because it's the traditional hackneyed stuff. Is the asset liability mismatches because your deposits are of maturity is far less than your financing in infrastructure could run into even 30 years, 10, 15, 20, 30 years. So certainly banks are not the right vehicle. So globally, it happens that corporate bond market is very deep, very liquid. Unfortunately, despite the best effort of the government and Reserve Bank of India, Indian corporate bond market has not got much. If you see some of the developed markets, the volume of trade in in corporate bond market is higher than the equity markets. But that's not the case in India. This is yet another attempt, and I think all of us should wish it success for infrastructure financing, because that's the key for the growth. If you are talking about a 5 trillion economy, if you want to reach there, we are already the 5th largest economy in the world, and we need to move ahead. Infrastructure is the key to our growth.
How would this NaBFID be different from the development finance institutions that have come in the past and from the existing institutions?
This NaBFID entity is very different from there. Even though it's a government baby and the budget announced it, you look at the papers, the origin of this organization, the government notice is there. It's an independent entity driven by the board. Even the appointments committee, the organization which clears all the appointments in public undertakings, they would clear it, but the government will not sign it off. It's the board that will sign it off. And they're looking for market-related, they're looking for right kind of talent, offering them market-related salary. So they are very, very different. And the government has opened up its purse. Government will support it, and because of the government backing, raising money from the market for it will not be very different. So, and the basic difference between other entities which have experienced so far and NaBFID is this: NaBFID has been positioned as a total solution for infrastructure use. What does it mean? It will give money in terms of debt, where it will complement the banks. Along with the banks, it can't always take over the entire loan burden. Second is, it will also give money through the bonds like NCDs, etc. So, for instance, if it's a 30-year project or 25-year project, it will give 15-year money as a sort of loan along with the banks. And when the bank stops at 15 years, the rest of it can give in terms of long-term bonds, NCDs, etc. And also it can pick up equity. So equity, bond, loan, all three of these. And it's also been invested with the power of developing the markets, which means apart from a financing institution, it will also look into the aspects of how to develop the corporate bond market. So it's a very vast assignment. And I'm told that it's in touch with multilateral agencies. It's charting its way. And as I have written, the first disbursement of 10,000 crore into a power project should happen before the Christmas.
As I am to understand, an independent board does not guarantee less scrutiny by the 3 Cs, the CAG, CDC, and the CBI. Would that still be a problem with NaBFID?
Yeah, I think you are absolutely on the ball. Ideally, it should have been outside the purview of the 3Cs, but it's not. And if I'm not mistaken, when it was announced, I think the government did say that it will be out of the purview. But if you look at the papers, the notification, it is not. This is the unfortunate reality of it. It will be under the glare of 3Cs. But I guess that's a minor irritant if it gets its act right, because it's not, it's not into getting into the recovery and cleaning up. There, all those issues are very critical. That are you compromised? Are you doing things, etc. When you are giving money, it's more the focus. It should be the right kind of project appraisal and the risk management and underwriting, where the earlier DFIs did not come out with glory. So this entity, NaBFID, would need to focus on that.
Thank you. Thanks a lot, Tamal, for your time this week. We hope to see you next week again. Thank you.
Thank you. Thanks.
Tamal says that the National Bank is a one-stop solution. It will also help deepen the corporate markets, which is much needed. Since we are discussing foreign investments in banks, we asked you last week whether the government should allow foreign investors to own a higher stake in banks. 56% of the people responded in the negative. The current rules for private banks allow a 74% investment from foreign investors under the approval route. This week, we would like to know if the government should also privatize public insurance firms. Our polls open on Friday and you can respond on Twitter, Instagram, LinkedIn, Telegram and our website. the government is looking to consolidate its insurance business. Whether it would be successful or not remains to be seen. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.